We want to continue from where we stopped last time. Remember, last time we were still doing consolidation, and that's exactly what we want to do and complete it. Now, today's session we may not be able to complete consolidation, but is one of the essentials that you will not want to afford, or you don't afford to miss, because it will have so much to do with consolidation as well. Last time we introduced how or prepare a group statement of financial position, and we did a good number of examples. Friends, today we want to see how to prepare a group statement of profit or loss. And not only that, we also want to see how to prepare a group statement of changes in equity. At this point still, we are looking at how to consolidate a holding company and a subsidiary. So that's what we want to do. Come and say consolidation. We are still dealing with the consolidation, and we are dealing with the holding company, and a subsidiary, where we have the holding company and a subsidiary. Today's session, friends, we want to look at preparation of a group statement of profit or loss account. How do we prepare a group statement of profit or loss account? We'll maybe start off with a format. Come and say a group statement of profit or loss account. We want to look at the format. Yeah, we want to have the format. Let me avoid this. So you will always have the revenue. You take the revenue of the holding company. Let me say H is the holding company, plus the subsidiary. We subtract intercompany sales. Then we also less cost of sales. You take the one for the holding company plus the subsidiary. You also subtract the intercompany sales or purchase. You add, let me try to squeeze this better. Come and say intercompany sales plus unrealized profits on closing stock, right? Minus unrealized profits on opening stock, plus depreciation under charge. Then you also subtract depreciation over charge. I think I could have extended this. I could have said this side to come up to that point, so that I can say here that we have shillings at this point, so that I can subtract depreciation over charge. So you subtract that, you'll have the gross profit. Then you can add negative goodwill, and other incomes. Then you less expenses. One of the expenses may be admin costs. Take the one for the holding company plus the one for the subsidiary. Then you adjust it here. You have the distribution costs. You take the one for the holding company and the one for the subsidiary. You get it here. You'll have the one, you have the impairment loss. The impairment loss, this is the charge for the year. The charge for the current year only. Then we have profit from operations. Profit from operations, you'll have it here. Then you less finance cost. Finance cost, you take the one for the holding company plus the one for the subsidiary. It's important to subtract the intercompany interest. If there is intercompany interest, you subtract it as well. Then you get this item here, you subtract it. Before that, you may have investment income. Investment income. This investment income, you take the one for the holding company plus the one for the subsidiary. You subtract intercompany income. Then you get the profit. You'll have the profit. You'll have the profit before tax. You less the tax expense. You less the tax expense. Tax expenses, you take the one for the holding company plus the one for the subsidiary. You get this. You'll have the profit for the year. Profit for the year. Then you less profit attributable. Profit attributable. Profit attributable to NCI. To NCI shareholders. And then you have the profit attributable to parent shareholders or to the holding company shareholders. That's what you should remember. Something very important that we'll have to explain, remember, we are taking the revenue of the holding company, H is the holding company, plus the revenue of the subsidiary, S is the subsidiary, minus the intercompany sales. We also have the cost of sales. Why are we subtracting intercompany sales in the first place? Should be remembered that if a group member has sold goods to another group member, if a group member has sold goods to another group member, that is not considered to be a sale. It's considered to be a transfer of goods. So there is no sale that has taken place. And that's why we should eliminate it from our sales. But there was a buying group member. The buying group member must have recognized it as a purchase, must have increased the cost of sales. And we have already said that there is no sale that took place. It also means that there was no purchase that took place. So we need to reduce our cost of sales by the purchases that was made. So these intercompany sales are just a idea. When it comes to cost of sales, it's the purchase. It was a purchase. So we are adjusting the same item. That's why we are using the same detail, that is intercompany sales. This is unrealized profits on closing stock. Unrealized profits on closing stock is in respect to the goods that were sold from one group member to another group member. At the end of the year, they had not been sold. So we need to adjust it so that we determine how much exact profit for that year. We subtract unrealized profits on open stock. These unrealized profits on open stock is not only unrealized profits relating to the previous year, but we are adjusting it so that we can determine exact unrealized profits to be adjusted for only that year. Remember, unrealized profits on open stock relates to the goods that were sold from one group member to another group member in the previous year. So we need to eliminate it because it does not relate to the current year. Then we have the depreciation undercharge and overcharge. Friends, you need to remember that depreciation expense on property, plant, equipment, whether you are told or not, it should always be a component of cost of sales, unless otherwise you have been told that it was an adjustment of admin expense or distribution cost. But if you have not been told that, you need to remember depreciation expense on property, plant, equipment will always be a component of cost of sales. If there was a depreciation that was overcharged or undercharged there due to either evaluation surplus adjustment or intercompany purchase of PPE, then that depreciation overcharged or undercharged there must have overstated or understated the cost of sales. If there was a depreciation undercharged in there, then it means that the cost of sales must have been understated. We must increase it with the depreciation undercharge. If there was a depreciation overcharged in the year, then it means, friends, that the cost of sales must have been overstated. We need to correct that and reduce our cost of sales by the depreciation overcharge. That's important to remember. Then we have negative goodwill or under other income. Negative goodwill is a profit because if we are paid less purchase consideration than what we have acquired, that is a profit. Then we come to expenses. Admin expense, you take the one for the holding company plus the one for the subsidiary. Distribution cost, you take the one for the holding company plus the one for the subsidiary. Impairment loss, we have taken the charge for the current year. Then we have the finance cost, you take the one for the holding company plus the one for the subsidiary minus the intercompany interest expense. How does intercompany interest expense arise? Intercompany interest will arise if and only if we did not only acquire ordinary shares in the subsidiary, but we also acquired the long-term debt, we acquired the debentures, we acquired the loans and all that. So in that case, there will be an intercompany interest expense which needs to be eliminated. Investment income, we should only recognize investment income from outside the group only, but investment income from a subsidiary, from an associate should not be recognized. We only need to recognize the investment income from outside the group. So that means we'll take the one for the holding company plus the subsidiary minus intercompany income. One of the examples of intercompany income is the dividend from a subsidiary. That is an intercompany income and need to be eliminated. We have the tax expense. You take the one for the holding company plus the one for the subsidiary. Then we get the profit for the year. That's like profit after tax. We less the profit or attributable to NCI shareholders. Profit attributable to NCI shareholders, we'll talk about that. Then we have profit attributable to the parent shareholders. Very important point here, friends. What we have done in this format, is that we have just simply added the revenue of H plus the revenue of the subsidiary. The cost of sales of the holding company, the cost of sales of the subsidiary. Admin expense of the holding company, admin expense of the subsidiary. Distribution cost of the holding company, distribution cost of the subsidiary. Then we have also taken the finance cost of the holding company plus the subsidiary. The tax expense, the one for the holding company plus the subsidiary. As if the post-acquisition period is more than 12 months, is either exactly 12 months or more than 12 months. What we have done, we have simply added the incomes and expenses of the holding company and the subsidiary on assumption that the post-acquisition period is either exactly 12 months or more than 12 months. If the post-acquisition period in the subsidiary is less than 12 months, maybe 11 months, 8 months, 6 months, 4 months, 3 months. If the post-acquisition period in the subsidiary is less than 12 months, then the items of the subsidiary must be apportioned on time basis to reflect post-acquisition period. We can put that as a note, very important note. The above format has been prepared on assumption that the post-acquisition period is either 12 months or more than 12 months. If however the post-acquisition period is less than 12 months, then the incomes and expenses of the subsidiary must be apportioned on time basis to reflect post-acquisition period only. Very important point there, that the items that need to be apportioned to reflect post-acquisition period only is this that I'm circling. This item must be apportioned on time basis. These items must be apportioned on time basis. These items must be apportioned time basis. These items must be apportioned time basis. It must be apportioned time basis. It must be apportioned time basis, including this one. It must be apportioned on time basis. So those items that I've circled must be apportioned on time basis to reflect post-acquisition period only, if and only if the post-acquisition period is less than 12 months. But if it's more than 12 months, we don't apportion.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.